This is a video about how to do net present value method. Net present value method is one method that you can use to do capital budgeting. So let's see, this is a sample question. Salsa company is considering an investment in technology to improve its operations. The investment costs $250,000 and will yield the following net cash flows. Net cash flows means total cash in minus total cash out. Management requires a 10% return on investments. Okay, see the table. For this proposed investment, the cost of the investment is $250,000 and the investment will generate this net cash flow for the period of 5 years. In year 1, the investment will generate $40,000, year 2 $50,000, year 3 $75,000, and year 4 $94,000, and year 5 the investment will generate $125,000. So if you are a manager, you have to do the capital investment analysis in order for you to decide whether the investment is a good investment or not. Net present value method is one of the methods that you can use to do the capital investment analysis. Okay, let's see. The question requires you to determine the net present value for this investment. To do or to answer this question, you can use values from the present value tables. Okay, let's see how to answer this question. How to do the net present value method. I have many videos related to management accounting in this YouTube channel. I suggest you to subscribe this channel to see the previous videos and also the future videos about management accounting. So let's see how to do the net present value method. So the first thing that you have to do, you see the number one the red number one here. So the first thing that you have to do is to show the year involved in this investment analysis. So for this investment, there is an initial investment, and then in year 1, year 2, year 3, year 4, and year 5 related to the investment. So and then you do the column 2. Column 2 you have to show the net cash flow. The net cash flow can be negative or positive. A negative net cash flow means net cash out. A positive net cash flow means a net cash in. So you see the initial investment. So for the net cash flow, when the business has to do investment, the business has to spend $250,000. So that is a cash out. That's why the value is negative $250,000. In year 1, the investment can generate $47,000. This is according to the question. Year 2, the investment will generate $50,000. Year 3, $75,000. Year 4, $94,000. Year 5, $125,000. You have to write that amount of net cash flow, and then you prepare the table, the column 3. In the column 3, you have to show the present value factor. These numbers, the present value factor numbers, you can get the numbers from the present value table. You have to look at the PV value. Okay, in this situation, the interest rate is 10%. So if you look at the present value table, for 10%, in year 1, the value of the factor is 0.9091, year 2 0.8264, year 3 0.7513, year 4 0.6830, year 5 0.6209. After that, you have to prepare the column number 4. Column number 4, to calculate the numbers in column number 4, you have to do this. Number from column number 2 times the number in the column number 3. For example, for the initial investment, negative 250,000 times 1 equal to, in column 4, you write negative $250,000. For item number 2 in column number 4, to get the number, you look at the column number 2, the number is 47,000, and then you have to times the number with 0.9091 in column number 3. Then you will get $42,728. You have to do the same thing for year 2, year 3, year 4, and year 5. Okay, so column number 4 equal to item in column number 2 times item in column number 3. And then after that, you prepare the column number 5. Column number 5 is cumulative present value of the cash flows. So in year 1, the initial investment is 250,000. And then you see year 1, how to get the number in year 1? To get the number in year 1, you have to add the initial investment, negative $250,000, plus the year 1 in column number 4. So plus positive 42,728. You will get negative 207,272. And then for the year 2, the way to do it is negative $207,272 plus 42,973. That is the item year 2 in column number 4. So you add the number. You will get negative $164,299. You have to do the same thing for every item in column number 5. And then you will see at the end of year 5, the number that you can see here is positive 33,864. So it means that for this investment, the net present value for this investment is 33,864. So now, another thing that you have to know is, if the NPV of an investment is positive, then it is a good investment, an investment that should be accepted. But if you calculate NPV and you find that the NPV is negative, then it shows that the investment is not a good investment. That's all for this video. Do not forget to like the video if you think this is useful, and you can share this video to others also.